Hello, this is Dan Passarelli with Market Taker Mentoring LLC. Today we'll be discussing volume and open interest. Before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Volume and open interest are two very important fundamental items that make a big difference in your option trading. But the problem is they're often very misunderstood, especially by new entrants into the options trading world. Volume and open interest are two decidedly different things that kind of go hand in hand with each other. You need to understand both in order to be able to use them effectively. Volume is probably the more intuitive of the two concepts that we're discussing here today. If you understand how stock trading works, you probably understand how volume in the options trading context works. Volume is simply the number of options contracts that are traded within a stated period. Now, generally speaking, that stated period is daily. Maybe 5,000 contracts in a particular stock, IBM, traded. If they don't state otherwise, they're generally speaking about a one-day period. Now, after that period, volume starts anew. It starts at 0 every morning. Open interest is different. Open interest is the number of contracts that have been created, and it's a running total that doesn't reset itself. It can fluctuate, it can go up and down, but it is a running total until the end of the life of the contract. Now, this may seem a little foreign if you've never thought about this before. In order to really understand the creation of an option contract, let's talk about the fundamental difference between options and stocks. When stocks are first born into existence, that is, when a share of an individual stock is born into existence, it's the result of an offering, an initial public offering or a secondary offering or what have you. Shares of ownership are sold to individuals and then those shares can be traded. But it's very different when it comes to an options contract. When options are first listed to be traded, there are no contracts. Contracts are created when two parties agree upon the terms of the contract. I like to make the analogy of it being like an insurance policy. When the insurance guy comes to your house, he doesn't say, oh, here, I have 3 policies, and holds them out and says, which one do you want? He says, okay, what type of coverage would you like? What type of deductible would you like? Is this an acceptable premium for your insurance contract? And once you agree upon the terms and sign on the dotted line, now the contract exists. You have purchased it from the insurance company who has sold it to you. That's how options work. A buyer and a seller agree upon terms of a contract, agree upon price, and thus create a contract. Now, the similarity and somewhat of a difference is that options contracts are very standardized. We kind of take for granted the terms of the contract. 100 shares of stock at a particular strike price that expires at a particular date. That's all very standardized. All we really tend to think about then is this price right for this particular contract that's available. But the contracts are created once a buyer and a seller both create an opening transaction with each other. Now, the first day, okay, let's go through an example. Let's say that today is the first day that October option contracts on XYZ stock are listed. One of the available strikes is the October 30 calls. Now, like I just got done explaining, no contracts yet exist on this first day at the opening bell. Open interest, therefore, is 0. And since no contracts were traded, volume, therefore, is 0. Now, let's say an individual named Joe Public decides to buy one October 30 call He goes into his online brokerage account, clicks on the offer, and pays whatever, $4 for them. He buys this one October 30 call from probably a market maker. That's where most retail traders trades are transacted with, is with a market maker. And this market maker's name is Mark McMaker. So now, once the transaction is complete, Joe gets his little pop-up that says, "You're filled. You now own this call." So now Joe is long one contract and Mark is short one contract. One contract now exists. Therefore, open interest is 1. Because that one contract traded, volume is also 1. Now let's say a little later that day, Joe's brother, John Q. Public, decides to sell short one October 30 call to Mark McMaker. Now Joe, the original party here, he's still long one contract. Mark McMaker, well, he traded out. He shorted it, and now he bought it back. He's flat. He's out. John Q, he's now short one. He opened a short position. So only one contract still exists. Joe's long one, and John Q is short one. Mark, he's out. He flipped his contract. Open interest, therefore, is still only 1. A new contract wasn't created, it just changed hands. Volume, however, is 2. The one contract got traded twice, and therefore it is counted as 2 contracts traded for the daily volume. Now let's say the next day, Joe Public sells his October 30 call to John Q. Public. Now remember, Joe's long, John Q is short, so they're both closing. Both traders close their positions. Joe's flat, John Q is flat. Now there are no open contracts. Open interest, therefore, has become 0. If this trade didn't occur, this next day open interest would still be 1, but because they both closed, it's now 0. Volume today is 1 because that one contract traded. Understanding volume and open interest is very, very important in order to really understand fundamentally what's trading in the options. Now, we could spend a whole lot of time talking about exactly how to use this information, but this is what you start with. If you have more questions about volume and open interest, you can feel free to visit markettaker.com